for certain what will happen. No matter who says that they can, the truth is no one knows, even if it's happened hundreds of thousands of times before. What you can do, however, is reduce the amount of risk that you take on. And that's something I'm doing myself, partly in response to AI. Okay, so before I explain how AI comes into this, we need to talk about the S&P 500 again. When you invest in the S&P 500, your money, it isn't split evenly between the 500 companies. In reality, a surprisingly large amount of your investment is divided across just 7 companies: Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla. These are often referred to as the Magnificent Seven, and each company is currently worth more than $1 trillion. In some ways, it's a good thing that these companies make up so much of the S&P 500, because when these companies do well, the S&P 500 as a whole tends to do well too, meaning your investments grow at a faster rate than if your money was divided equally between all 500 stocks. The downside, of course, is that if things went wrong with one or more stocks in that Magnificent Seven, this could have a pretty big impact on your investments, because how much of the overall S&P 500 each of those 7 makes up. So what does this have to do with artificial intelligence? Well, all 7 companies are investing heavily on AI. And this isn't automatically a bad thing. These big investments could pay off, and there's always a risk that failure to invest in new technologies could in fact leave companies behind. The problem, however, is that when lots of companies become extremely valuable because investors are excited about the same trend, things can sometimes become a little bit overheated. This isn't the first time we've seen something like this happen. So back in the 1990s, for example, it was the dot-com bubble. At the time, investors began pouring money into almost anything linked to the internet in the hope of finding the next big thing and making a huge profit as technology continued to grow. This helped push stock prices really, really high, far beyond what companies were even realistically worth at the time. And that bubble that we were in, it got bigger and bigger until it eventually burst. And while some companies did really, really well, they survived and went on to become incredibly successful. On the other side, a lot of companies actually saw their share prices massively fall and went out of business. It just goes to show that even the most successful technology that changes the entire world can still become overhyped in the short term. Now, personally, I do think AI is going to transform a lot of industries and probably become a huge part of everyday life. But that doesn't necessarily mean every company investing heavily in AI can justify its current valuation, or that stock prices will keep rising at the same pace forever, which is why I'm changing how I invest my money. And by the way, we're going to cover how I'm changing what I invest in throughout the rest of the video. But there is so much more to investing and what to invest in that takes far longer than 15 minutes. So if you want to take this even further and dive even deeper, I'm releasing a completely free workshop this Sunday. I held the workshop in November. I held it again in January, and we've had over 75,000 people in total registered. We also asked people to fill in a survey after the workshop where 96% of people said that they felt so much more confident about what to invest in and how to invest, and actually took action after this workshop. So I'm now releasing the workshop. You can sign up at nischa.me/invest, completely free. I'll walk you through how to invest, what to invest in, how to accelerate your investment returns over time, the single biggest mistake new investors make and how to avoid it, and also how to calculate what you need to eventually live off of your investments. Again, it is 100% free. You can sign up at nischa.me/invest anytime before the doors close. Let's move on. So what has changed? As we touched on earlier in the video, one of the things that makes the S&P 500 such a great investment for so many people is that it offers diversification, which is one of the most important principles of investing. And again, put simply, it's about not putting all of your eggs in one basket. If you invested all of your money into one company and that company failed, you could lose everything. But if you spread your money across lots of different companies, you've got a much better chance of success over the long term. So if you don't have much money to invest and you're looking to buy your first index fund, the S&P could be a very good place to start because you instantly get exposure to hundreds of businesses, often for a similar price or even less than buying just one. However, now that we know that the S&P 500 is so heavily reliant on just 7 companies, maybe the best way to get true diversification is to take things a step further and invest across different countries, not just the United States. Because whilst the US has performed incredibly well over the last decade or so, there is no guarantee that that will always be the case. In fact, if you look throughout history, the country dominating the global markets has changed many, many times. Back in the early 1900s, for example, the UK made up one of the biggest parts of the global stock market. Britain was one of the world's biggest economic powers, and most people assumed that that would just continue. But it didn't. Of course, things changed. A similar thing happened in Japan during the 1980s and early 1990s. At the time, Japanese companies were performing incredibly well, particularly in areas like technology, manufacturing, and a lot of people believed that Japan was the future. And then it wasn't. Today, the US dominates the market. The point is, no country is guaranteed to stay on top forever. And the reality is that nobody really knows where the biggest growth will come for over the next 10, 20, or 30 years. That's why I've always invested globally alongside the US. And going forward, I'll be directing a larger percentage of my investments towards global stocks. This isn't because I think America is doomed or that AI is going to fail. I'm simply trying to reduce my risk and make sure my portfolio is diversified across lots of different countries, across lots of different industries, and just making sure that I'm best equipped for all possible future scenarios. Because when you only invest in the S&P 500, you miss out on lots of incredibly successful businesses based everywhere else in the world, like Samsung, Toyota, Nestle, AstraZeneca. These are huge global companies operating at scale, but they're excluded from the S&P 500 simply because they're not in the United States. So, what does this mean for you? Even though I am changing how I invest my money because of AI, that doesn't mean you have to do the same thing. Again, investing isn't about trying to predict the future because the reality is nobody knows what's going to happen next. AI might completely transform the economy and continue pushing markets even higher. Or excitement around it could cool off and some companies might struggle to justify their current valuation. The point is, you don't need to know exactly what happens to be a successful investor. You just need to build a portfolio that can hopefully perform well across lots of different possible scenarios. And that is actually how I think about my own portfolio. For me, around 80% of my investments are in diversified funds. That is the foundation. That is the part of my portfolio designed to grow steadily over the long run without me needing to constantly worry about what's happening in the market. Then around 20% is invested in individual stocks. This is where I'm willing to take more risk and invest in companies that I think have the potential for bigger returns. But, and this is really important, it is the money that I lose sleep over if things don't go to plan. In fact, if you're a newer investor, I'd probably suggest keeping a smaller percentage in individual stocks, maybe something even closer to 5%, if that. That's because the